previous topics in this learning module talked to you about mutual funds that had debt or equity portions assigned to them. It also mentioned to you that there was a management fee for professional managers who actively manage that portfolio of debt funds or equity funds. In India, those fees run at 2% per year and are amongst the highest on the planet. It's not surprising, therefore, that cost-conscious people that we are, we should be looking for lower-cost ways of obtaining the kind of diversification that those debt or equity mutual funds supposedly provide us with. This is why the ETF or the exchange-traded fund has become popular in India in recent years. So let's look at what a hypothetical exchange-traded fund or ETF might look like. Typically, a financial institution, usually a brokerage house, puts together a basket of stocks into this ETF product. Let's give it a name. Let's call it FMC for fast-moving growth consumer goods companies in India. Let's suppose next that this particular FMC ETF has two stocks in it, Hindustan Lever and Titan. Let's suppose further that the ETF decides that 75% of the portfolio, this basket, is going to have Hindustan Lever, and the remaining 25% is going to have Titan in it. These proportions, 75 and 25, are fixed at the time the basket is created and do not ever change. Of course, this proportion of 75 Hindustan Lever and 25 Titan will change if the financial institution creating the ETF decides to include other FMCG companies in that basket. Whatever that ETF ends up consisting of, it will trade as a single security. Any dividends received on the stocks in it are automatically reinvested back into that ETF. The fund that creates the ETF, the fund house that creates the ETF, can redeem these securities as and when it sees fit. Individuals can buy and sell into these ETFs directly. The key here is that this is passive. There is no portfolio manager involved, nobody to whom you are paying those high 2% fees. There are, of course, both advantages, like the lower cost, and disadvantages to not having a portfolio manager, which is a topic that we will turn to next. The portfolio managers who manage your mutual fund portfolios sometimes make mistakes. Some are good, doing things in your interest. Others may be acting upon their own. Globally, though, the performance of portfolio managers of these active mutual funds have not really provided their investors with a rate of return that is particularly good or beats the benchmark against which their performance is subject to. Therefore, the question you should ask yourself, and we've mentioned this earlier as well, is why should you be paying those higher costs to these managers if they're not performing that well for you? So if not paying a portfolio manager who performs badly is an advantage to you if you go the ETF route, there is a disadvantage as well. What if news comes out about one of the companies in the ETF, particularly if it's bad news? There is no portfolio manager there who can take action to limit your losses. You will have the losses incurred because the portfolio weight of that badly performing company remains constant in that ETF, while the manager could have and should have changed his allocation after that news came out. Second advantage to the ETF is that it trades like a single equity. It has its own ISIN number and all those associated details. That's the reason for the exchange-traded part of its name. But what it's doing for you, like in our hypothetical FMC ETF, it gives you exposure to the entire FMCG space by one single transaction to buy or sell it. Because the ETF represents many stocks, you can expect higher trading volumes and better liquidity with that ETF. Remember that liquidity means the ease with which you can get in and out of individual securities or ETFs, so an ETF being liquid is really important. In addition to that, even within our hypothetical FMC ETF that we just created, it's possible that you didn't like the 75% weight that was given to Hindustan Lever or the 25% weight that was given to Titan. You might have wanted to be in the FMCG space, but created something with different weights. In the West, even for the same sector like FMCG, there are multiple ETFs that are available, not in India as yet. But what I'm trying to get you to see is that if you want exposure to FMCG, you could pick an FMCG ETF, hypothetically, that has overweighted to large cap stocks or overweighted to mid cap stocks, however you prefer them. A third advantage of the ETF is that unlike mutual funds, where the price or the net asset value of that mutual fund is calculated usually at the end of every trading day, the ETF has prices that fluctuate through the course of any day as the prices of the component stocks in that ETF fluctuate. You can buy it, hold it, sell it, trade it, short it, do whatever you want with this ETF, being assured that the volume and the liquidity is there for you to take advantage of.